right, our next guest has been predicting the dollar's big run and the negative effects that come with it for quite some time. Here's what global macro investors Raoul Pal said back in January on Fast Money.
I think the US dollar move has barely started. I think this year, all things being equal, I think we may have one of the biggest moves we've seen in a long time in the dollar. I think we have a potential for a plus 15, plus 20% year in the US dollar. So if that's the case, then oil's going to come down further.
The dollar index is already up 7% since that call. Joining us once again on the Fast Line is Raoul Pal of the Global Macro Investor. Raoul, always great to speak with you.
Hi, Melissa. Great to speak to you.
The prediction on the dollar index from you is pretty shocking. Where do we go from here?
Well, I mean, if we look year to date, it's already up 9%, and that's only by the 10th of March. And I think that, yes, we're going to get a bigger correction where it pauses for longer, but my view is it's probably going to be up at least 25% this year alone, if we look back historically how these big dollar bull markets go. And I think it's going to go at least to, using the DXY, at least to 125, maybe even further.
And so, sort of connect the dots for us. If the Dixie goes to 125 or further, oil goes to 20, and what impact does that have then on the CPI?
Yeah, I mean, the CPI is very interesting because the bond market is kind of looking at lagging indicators right now, which is the CPI, which the Fed are talking about as well. They're looking at core CPI. Now, core CPI lags by about 8 or 9 months, maybe slightly longer. So the chances are that if we see oil fall down to $20, then we could see CPI and core CPI well into -2, -3%. I don't think people are really expecting that, and I think that's a big issue going forward.
Our people aren't expecting it. Are you expecting it?
Yeah, I am. I'm expecting much more deflation than people are imagining right now. I mean, the oil price move is so fast that even priced in yen, which is the fastest falling currency, it's still kind of fallen 50% in yen terms. So everybody's going to feel this huge bout of deflation, and that builds through the product cycle, because as you manufacture things, you do it at cheaper costs and it comes through. So all of that coming through to the core CPI is still yet to be felt, and that's going to come. And obviously that's going to help the bond market somewhat too.
In terms of oil going to $20, I mean, you have a couple of fundamental reasons why. I mean, it's not just the dollar strengthening that is powering or pressuring oil to the downside. It's also a couple of shocks, demand shock and supply shock, correct?
Yeah, absolutely. I mean, I think the key thing to focus on now, I think most of us are familiar with the supply shock in oil that came and the demand shock from a weaker China. But the really significant thing right now is the fact that oil companies are trying to look through what they deem to be a kind of short-term valley in the price of oil, and they're hoping that the oil price will rally in due course, so they're chucking as much oil into storage as possible. So the storage facilities across America are filling up at an incredible rate and should be potentially full, so there's nowhere to store oil on land in the whole of the continental United States by June or July. And in which case, any oil that is then brought out of the ground either has to be sold in the normal market, which will be at much cheaper prices, or they're going to have to shut down production. I think that shutdown of production is something that people haven't really thought through yet.
And then the demand shock is coming primarily, in your view, from China at this point.
Well, it's obviously Europe's slow. China is very weak right now, and they were always the marginal consumer of oil. But then at the margin, the US looks like it's slowing down as well, and potentially with the oil patch being so lackluster, there's a chance, as I mentioned before on the show, that there's a probability that the US goes into recession next year alone. So all of those factors combined make it very difficult for the oil price to have any sustainable rally.
We're also showing right now on the screen, Raoul, the chart that you have in your latest newsletter, and that is the technical chart of oil, basically the notion that not only are these fundamental pressures on the price of oil, but technically speaking, the trend is for oil to go, in fact, to $20. What happens to the oil industry if it goes to $20?
Well, I mean, it's a classic boom-bust cycle, unfortunately. So much money has piled in to the oil patch over the last 5, 6, 7 years. And much of that money is going to get destroyed. I mean, as is very typical. We've had it, we've seen it in everything from railroads to internet. So the problem is so many of these companies are going to have to shut down production. And the economic damage from that, both in terms of loss of wealth and also loss of production, is significant. I mean, it's not the end of the world, but it's something that could create larger problems for the rest of the world. It's not only just the US that has had a big oil production boom, so there's many other countries who are going to get caught up in this.
Will we see the damage from the energy industry impact overall corporate bonds? I mean, energy is the biggest component of the U.S. high-yield bond market. Will we see that trickle through?
Yeah, it absolutely has to trickle through. And one of the reasons why that happens is, you were talking about financials before I came on the show, and the reason is financials have lent money to the oil companies and the investors in oil companies. So at some point, people the banks are going to suffer somewhat in this. They're going to tighten lending to other companies, and people are just going to be more risk averse when it comes to lending companies money. It's a simple fact, and it's very typical of the credit cycle. So even good companies end up having to pay more for our money.
All right, Raoul, we're going to leave it there. Thanks so much for phoning in. We always appreciate your insights.
Great. Thanks very much for having me.
Raoul Pal, global macro investor. Oil to 20, Dixie to 125, the trickle effect to high-yield corporates. What do you think? You buy it? Is this an alarmist scenario? Because a lot of people out there, the last one was on, a lot of people said, you know what,
things that came out of that conversation.
He's Chicken Little, but you know what, everything that he said the last time was
totally
right.
came true. And you know what, when I look at the Dixie on a long-term chart, because I've been looking at the same chart that he's looking at, 121 is your resistance to the upside. If we break through there, he said we're going to 125. If we break through 121, we're going a hell of a lot higher than 125. So it could be even worse than he's talking about.
I thought you were going to say hell in the handbasket.
But forget charts here. I mean, we think about what's going on. The industrial commodities and now the dollar going this way. This is the Fed unwind. This is the end of QE, and this is what maybe the end of ZIRP looks like here, people.
Right.
I mean, we've been focused.
We've never done this before.
Well, no, but we've been focused on equities. That was the bubble that had to pop, and bonds had to pop. But it really, they could come. That could be coming to a theater near you. But you've already seen part of the Fed unwind.
Karen?
Well, you know, listening to him, Little Miss Sunshine there, I was wondering, though, what is the fly in the ointment to, it all makes sense the way he lays it out. It's a very, you know, you can follow the logic of the argument, but I feel like we could see the fly in the ointment might be Europe actually having some response to the ECB's efforts.
Right.
Maybe an improvement in the...
perk up.
Right. And that could reverse, but it's a dire circumstance.
And he brings up supply demand, and we all understand that pretty well, I think, by this point in time. But I think the other thing to remember is if you look at the way oil's been trading, first of all, it's been in this range, 48 to 52, let's just call it. It's been there for a while. You look at the oil volatility index, it spiked all the way up to 64, finally cracked underneath 50. But when you look at what's been pushing oil, and every day, look at it from 11 to 1.
Right.
That tells me machines as well as margins are a big factor in where oil is today within that 48 to 52 range.
So are you saying that 20 is not in the cards because it's machines?
There's something getting in the way of it now, but I'll take the other side of it. I agree with you. It's machines, which makes the unwind of what we're seeing, this false stability worse.
False stability, correct.
Financials getting hit today despite